In this video, we're going to talk about the option Greeks, and it's going to be very much a beginner friendly discussion. So sort of like an introduction, we're going to talk about what they are and then just go through one example. So we're not going to talk about, strategy. We're just going to get a good foundation and a good understanding of exactly what the option Greeks are. Now, I would recommend that you have a good base of what options are, how to buy call and put options, selling options, and then a good introduction about option prices. And we've discussed all of those in previous videos. So you want to know a little bit about, in the money, at the money, and out of the money options, as well as intrinsic and extrinsic value. When you have a kind of a good foundation there, it's good to now sort of move on to the Greeks. And that's exactly what we are doing. So on the screen here, I have this article and I will reference it below this video. At the end, we're going to go through an example, and you can certainly reference this article if you need to sort of read through this a few times. Personally, I found learning options. I use ChatGPT along with studying blogs and various YouTube channels, and I find that I need to go over this stuff quite a few times. So certainly you can get access to this article if you wish. So again, this is going to be a beginner friendly introduction, and basically the Greeks, you can think of them as a special math rule that sort of tells us how the price of an option might change in the future based on certain factors. Now, in my opinion, beginners don't need to worry about memorizing or understanding the complex math that's behind the Greeks right away. That's something that if you want, you can maybe look into later on. I think it's more important to just grasp what each Greek represents and then how it can influence the price of an option. So, you can think of the Greeks as, tools that give you insights into risk and potential price movements, rather than formulas that you need to sort of calculate on your own. So again, as you gain more experience, you may find it useful to actually look at the math behind options and behind these Greeks, but to just start with the introduction and sort of learning about what they are, you certainly don't need to do any math work right now. So for me, when I was studying this, I actually used ChatGPT, and I asked ChatGPT to sort of explain the Greeks to me for a pure beginner that is just learning them for the first time. And it actually gave me this really good analogy that I'm going to share here in this video. So this is what ChatGPT sort of did when I asked it to explain the Greeks for a beginner. So it gave this analogy. Imagine you are a pilot and you're flying a plane. Now, to ensure a safe and efficient flight, you monitor several instruments that tell you how the plane is performing under current conditions. These instruments include your altitude, your speed, direction, and fuel levels. Each of these readings helps you make decisions to reach your destination safely and on time. So I think we can all relate to that. If you think of a pilot, flying a plane, they've got all sorts of instruments and measurements that they're tracking so they can land their plane safely. Now, in the world of options trading, the Greeks serve a similar purpose as those flight instruments, but instead of measuring flight conditions, they measure how different factors affect the price of an option. So here's a simplified breakdown of the most commonly used Greeks. And we're going to relate this to this pilot and this plane analogy. And then after that, we're going to discuss the actual formal definitions as well. So the first Greek that we have is called delta. So you can think of delta with this analogy like the speedometer. It tells you how fast the option's price is expected to change as the price of the underlying stock moves up or down. So if delta is high, then a small change in the stock price can cause a big change in the options price. And again, we're going to go over a formal definition afterwards, but here, just think of it, delta is like your speedometer, tells you how fast the price of an option is going to move when the stock moves up or down. And then you have gamma. So gamma is like the acceleration gauge. It shows you how quickly the speed of the option's price changes based on this acceleration when the underlying stock price moves. So gamma is like acceleration, and it affects the speed, which is the delta. So Gamma affects delta. So the acceleration is going to affect the speed of the plane. So that's what gamma does. Then we have theta. You can think of theta like the fuel gauge. So measuring what's called time decay. And there's time decay with options. Remember, options are sort of a wasting asset. They have an expiration date. So as each day passes, the quote unquote fuel or the time value in the option decreases. So theta is going to be a value that you minus off the price of an option every single day. So just like you're flying your plane, you're losing fuel every day. And then we have Vega and Rho. So Vega measures sensitivity to volatility, which is similar to maybe measuring the turbulence in a flight. So if the market is turbulent, meaning that if the price of an option is going up and down, it's very volatile, it's moving around a lot, then Vega will tell you how much the price of the option could change. So if an option has a higher Vega, that means that the option's price is more sensitive to changes in velocity. And then we have Rho, and Rho is like measuring how changes in wind speed or interest rates can affect the plane's journey or the price of the option. So it tells you how much the option's price might change when interest rates go up or down. It's not as popular, it's not as used as often as the other ones. It's more relevant for long term options. So again, those are the five very popular Greeks that are used. And again, delta, for our analogy here, flying the plane, that's the speedometer. That's going to tell you the speed at which the price of the option changes when the stock moves up or down. And then gamma is like the acceleration gauge. So as it accelerates, it's going to change delta, which is going to affect the option's price when the stock price moves. Theta is like your fuel gauge. So it's the time decay. It's going to tell you how much your option is losing every day based on the time value that's left in the option. And then Vega relates to velocity. So sort of like turbulence in the plane for every one increase percent in the implied volatility. So as the implied volatility of the stock goes up or down, the price of the option is going to change. And then Rho changes based on interest rates. So that tracks the interest rates. When the interest rates move, the price of the option moves. So, the Greeks help option traders. What they do is they help us understand how different factors affect an option's price, much like how various instruments help a pilot understand and react to various flying conditions. So this understanding enables traders to make more informed decisions, manage risks, and then strategize their trades more effectively. So that analogy, whether you understood everything we just went over, I think it's a good thing to keep in the back of your mind, because when we go over these definitions more formally now, if you kind of don't remember things, or if you're having a problem relating each one to the other, just think back at those that plane analogy. At least for me, that example really helped when we dive into the actual formal definitions now, relating it back to those flight instruments that a pilot might use. I thought was quite helpful. So let's go into like the actual formal definitions now of these popular Greek. So it's important to remember each Greek value, it's specific to the individual option contract. So they aren't specific to the underlying stock, meaning that if there are various options available, maybe for a stock like Tesla, the call option with a strike price of 170 is going to have different values for the Greeks as opposed to the similar option, but maybe with a strike price of 175. Again, so these values of the Greeks pertain to specific options, not just the underlying stock itself. So it's always related, and it changes based on the specifics of each option contract. So it's important to know that. So delta, again, delta was our speedometer, and what it really does is it measures an option's price sensitivity to changes in the price of the underlying stock. So for call options, delta ranges from 0 to 1, and it indicates how much the price of the option is expected to move for $1 change in the underlying stock. And then for puts, it has an inverse relationship. So the delta is going to be from -1 to 0. So it's a negative number. And basically it does the same thing. When the stock moves up or down by $1, the option price is going to change by that delta. So for example, a delta of 0.5, what that means is when the option price, when the stock price moves up by $1, the option price is going to move up by 50 cents. So for call options, that would work. And then if the price of the stock falls by $1, then the call option will fall by 50 cents. And then for put options, it just has an inverse relationship. If the stock goes up, then the put option would fall. And then if the stock drops, then the put option would rise. So that is delta, measuring an option's price sensitivity to a dollar change in the underlying stock. So again, call options, they gain value when the stock price increases and lose value when it decreases, proportional to their delta. So the delta will tell you how much the option's price will go up or down based on $1 movement in the stock price. So gamma now, remember, gamma was the accelerator gauge. So delta was the speedometer showing you the speed of the change in the option price. And gamma is the accelerator. It measures the rate of change of delta with respect to changes in the price of the underlying stock. So it shows how delta is expected to change as the underlying stock price changes. So a simple example for understanding gamma, you own a call option on a company, let's call it Fruit Tech. And let's say that the delta of this option is 0.5. So again, this means that if the stock goes up by $1, the price of your call option is going to increase by 50 cents. The delta is 0.5. Now, suppose that the gamma is 0.1. So the gamma for this option is 0.1. And what this means that if Fruit Tech stock price goes up by $1, not only does the option's price increase by the delta, but now delta itself is going to increase by gamma. Remember, gamma is the accelerator. So the speed is delta, and then the gamma is the accelerator, and it's going to affect delta moving forward. So it's going to go up by 0.1 because that's what gamma is for that option. So after the stock price goes up by $1, your option's delta now is going to be 0.6. It's going to be 0.5, the original delta, plus the added gamma. So this change means that if Fruit Tech stock goes up by another $1, your options price doesn't just go up by the original delta as it would have based on the prior rise, but now it's going to increase by even more because gamma's changed delta. It's going to increase by 60 cents, reflecting this new delta. So this shows how sensitive the option is becoming to changes in the stock price as the stock price moves. So in simple terms, gamma helps you understand not just how the option's price will change with the stock price, but how the speed of this change, how delta adjusts as the stock moves up or down. Okay, so now we have Theta, Vega, and Rho, and these ones are a little bit more straightforward. Theta, basically, this just measures the sensitivity of the option's price to the passage of time. So again, this was our analogy, our fuel tank. So we're losing fuel as we are flying the plane. And again, in option terms, this is referred to as time decay. Theta is time decay. It represents how much an option's price is expected to decrease every day, holding all other factors constant. So again, options lose value as they approach their expiration date, and theta gives a measure of this rate of change. So theta is going to be a number that, if everything else was equal, your option price would lose that value every day. And then Vega measures sensitivity to changes in implied volatility of the underlying stock. And again, we talked about what implied volatility was in our last discussion on option prices. Implied volatility, it represents the market's expectation of future volatility in the stock. So Vega is going to indicate how much an option's price is expected to change with 1% change in implied volatility. So if the implied volatility changes by 1%, then the option's price is going to go up by the value of Vega. So that's what Vega is, volatility. I'm getting mixed up with planes here. And then lastly, rho, that measures an option's sensitivity to changes in interest rate. So it represents how much an option's price is expected to change with a 1% change in the risk-free interest rate. And again, rho is not used as much. It's more significant for longer term options. Now, when you are, wondering about where you find these Greeks, these kind of sound foreign. They're just these numbers. Where do you actually find them? Well, when you're in your dashboard, if you are on your brokerage account, you'll be able to find a list of options for a particular stock, and that's called the option chain. And within that chain, you'll be able to access all these values for a particular option. So you click on the option and you'll be able to find the value of, delta, gamma, theta, vega, and rho within your trading dashboard. So if you're not signed up with a broker at the moment, you don't have an account, don't worry. Once you sign up for one, it's going to be very, very easy to go in and find these values before you would buy or sell any option. So they're in your dashboard and they're very easy to locate. And again, one thing to note that I was wondering when I was learning this stuff is this concept that the Greeks are specific to each option. So they're not uniformly tied to the underlying stock itself. And the reason is, they change based on various factors. So again, they're not tied to the underlying stock itself, but they're tied to the specific option contract. So things like, the strike price of an option and its expiration date are going to affect what the values are of the Greek. So options with different strike prices or, different expiration dates are going to have, different sensitivities to market movement. So, the delta, vega, and the time decay, it's going to be different for options that have different strike prices and time to expiration, even if they are on a stock that is the same. So if you just think about that, an option with Tesla, as an example, if it expires this Friday, that's going to have a much different extrinsic value versus an option that it has maybe 60 more days until it expires. So, the values of these Greeks are going to be different for different options. Again, market conditions play a role as well. Implied volatility can vary for options based on how much the market perceives future volatility. And then with strike prices that are in the money or out of the money are going to affect what the value of Vega will be for those different strike prices and expiration dates. Now, what I thought we would do is sort of take everything that we've learned just based on definitions and pure introduction to the Greeks and just run through a really simple example where we walk through a specific option that has a specific strike price with the stock trading at a specific strike price. It has a premium that we're going to outline, and then let's run through what happens as we look at the delta value, and that changes the options price, and then we look at gamma, theta, vega, and rho in this really simple example. So let's jump over to the whiteboard and we'll check that out. Okay, so let's walk through this simplified example and see how the Greeks affect an options price. And let's start with a stock price that is at $100. So the stock price is at $100. And let's imagine we're looking at a call option for this stock that has a strike price of $100. So a strike price is 100 and the stock is trading at 100. So what that means is that this option is at the money. If we can remember, in the money, at the money, and then out of the money. So as soon as the stock price goes up above $100, that would mean that the call option would be in the money because we have the right to buy at 100 and the stock's trading for over 100. There's some intrinsic value, but at this very moment, it's right at the money. So the stock's trading for 100 and our strike price in our contract gives us the right to buy at 100. And let's pretend that it expires in 1 month. So what that means is that there's 30 days left till expiration. So the expiry date is going to be 30 days. And we have a premium. Let's pretend that the premium, so the price of this option is going to be $5. So if we can remember from, intrinsic and extrinsic value, there's no intrinsic value in this option because if you take the stock price minus the strike price, we have $0. It's not in the money. It is at the money. So there's no intrinsic value right now, but the option is still worth something and it's priced at $5. And that's because it still has time left till expiration. It still has 30 days. So there's still a probability that the stock price will go up above the strike price, giving this option some value. And that is shown at this $5 premium of extrinsic value. So there's $5 of extrinsic value there. So there's just a little refresh of, intrinsic, extrinsic value and in the money and at the money option. So let's run through these Greeks here and we'll start with delta. So let's suppose that the delta for this option is 0.5. So again, what that means is that for every $1 increase in the stock price, the option price is going to move up by 50 cents. So let's pretend that the stock price now goes up to $101. So it's gone up to 101. So the stock price has risen to $101. So what's going to happen to the option price? Well, with a delta of 0.5, that means that for every $1, the option is going to go up by 50 cents. So the new option price after this $1 movement is going to be, $5 plus the 1 times 50 cents. So our new option price at this moment is going to be $5.50. So the option gained 50 cents based on the delta because the price of the stock moves up. So the option price is going to go up. So, our option is right at $5.50 at this moment. So now let's look at gamma. So gamma, remember, is the acceleration of delta. So let's say that for this option, the gamma was 0.1. So what this means is that delta will increase by 0.1 for every $1 move in the stock price. So right after the increase, so after this $1 increase here, delta is going to change. It's going to be the 0.5 it originally was plus the gamma. So we have a new delta of 0.6. So now if the stock moves up to 102, what's going to happen to our option price? Well, it was at $5.50 right here, but now we have another dollar move in the stock. Therefore, we have a move in delta, but delta's changed now because of gamma here. So we have 0.6 as our new delta. So what we would do is we would add, 5.5 with the original option price plus this new delta, which has been increased by gamma, and we're left with a new option price of $6.10. So just these examples, we can see that the delta changed, and when the stock's gone up by $1, we added 50 cents to the option, and then it goes up by another dollar, and we add 60 cents now because gamma has changed delta. And now when the stock's risen by $2, our option price has gone up by $1.10. So now let's look at time decay, theta. So imagine that the theta for this option was 5 cents per day, reflecting again how much value the option loses each day to time passing. So the option's price is going to decrease by 5 cents every day to time decay. That's what theta represents. So if we just did the simple example, we were 6 $5.10. And after 1 day, we're just going to minus the 5 cents. So we'll minus the value of theta there, and our new option price is going to be $6.05. So we've lost 5 cents to theta. Now, Vega, this is the volatility impact. So let's suppose Vega for this option is 0.2. And what this indicates is that the option's price is going to change by 20 cents for every 1% change in the implied volatility. So let's pretend that the stock's implied volatility, it increases by 1%. What this means is now the option's price is going to increase by 20% because Vega here is 0.2. So here we're going to have our option price of 605, and we're going to add 20 cents of Vega, and our new option price is going to be $6.25. And if we think about that, as the volatility increases, the price of options tends to increase. There's more probability that the stock price is going to go even higher into the money, or it's going to increase in value even more. There's more value in that option. Therefore, that's reflected in the price of the option. And then lastly, the interest rate sensitivity is measured by rho. So let's assume that for this option, the rho was 0.01, showing that the option's price is going to change by 1 cent for every 1% change in interest rates. And if we pretend that for this just example, 1%, the interest rate goes up by 1%. So we will take our $6.25 option and we'll add 1 cent for the interest rate change. And we're left with an option price of $6.26. So there is sort of a rundown of how these Greeks affect the price of an option. And we sort of did them one by one. We did delta, gamma, theta, vega, and rho. Just understand that for example purposes, that makes sense to sort of learn and see how these things affect the price of an option. But in the real world, know that these are all sort of happening simultaneously at the same time. So the price is certainly going to bounce around and reflect all of these different Greeks as opposed to just one at a time. But I think that was a good rundown to see how the price, our original price was $5 for this option, and it changed to $6.26. And that was because the price of the underlying stock went up by $2, which meant that the delta affected the price of the option, and then gamma kicked in with accelerating the delta. And then we had time decay pull back a little bit on the option. And then we had some volatility increases and interest rate increases, and that jumped the price of the option as well. So there is a simple example seeing how the Greeks can affect the price of an option. Okay, so thank you so much for watching this introduction to the Greeks. I hope that you found it useful. Below this video, you can find the article that we referenced in this video, and you can find a link to the playlist of our option videos here on YouTube. Certainly subscribe to the YouTube channel. And if you're interested in becoming a full-time day trader, I'm on a journey to become a full-time day trader. You can find our website, our podcast. We have a online community that we're building as well for other beginners. So certainly check all the information out below this video. I hope that you found it useful, and I will see you in the next one. Take care.